In this video, we're going to follow pages 62 through 65 and pages 74 and 75 in your textbook. We're going to follow the high-tech company. We're going to look at 13 different transactions that they experienced in the course of a single month. And we're going to look at how that affected the assets, liabilities, or stockholders' equity accounts, and then how we would journalize those. So let's start with the first transaction. On March 1st, High-Tech sold 1,000 shares of common stock for $12,000 cash. Now this means it sold 1,000 shares of stock in its own company to people out there in the public, and what it received in return was $12,000 in cash. Let's first analyze the effects on assets, liabilities, and stockholders' equity. When the company sold 1,000 shares of common stock, what part of this accounting equation was affected? If you said that the 1,000 shares of common stock was an increase of $12,000 in contributed capital, then you are correct. What else was affected? Exactly. The company received $12,000 in cash, right? Which means there was a $12,000 increase in the cash account, which is an asset account. Now, if you were going to journalize this, first off, what was the date? Yes, March 1st. What account? We know there was an asset account, and I said it was cash. And we know contributed capital was affected, and that's the common stock account. Which one received the debit? Well, it would have to be the increase in the asset account, right? So cash had an increase, and that's a debit of $12,000. And common stock had an increase, and that would be a credit of $12,000. Now, let's see this written out more neatly. We have an increase of $12,000 to an asset account and an increase of $12,000 to the contributed capital account. The date, March 1st. Cash has a debit of $12,000. We know there was a credit to common stock of $12,000, and we put a memo in this journal that says we issued common stock. That was the event that caused this journal entry. All right, moving on to transaction number 2. High-Tech, on March 2nd, borrowed $3,000 from the bank for 1 year at 8% interest. Now, on March 2nd, what was the effect on the assets, liabilities, or stockholders' equity for High-Tech? They borrowed $3,000, so there must have been an increase in liabilities, right? When they borrowed the money, what did they get? Yeah, they got $3,000 in cash, so there was an increase to an asset account. Now, if we journalize that, we put in the date, then we say which account was affected. Well, I've got 2 accounts affected, cash and what we'll call here notes payable or loan payable, something like that. We'll use notes payable, that's what your book used. Well, let's look here. We had an increase to assets of $3,000, an increase to liabilities. That increase to assets was the increase to the cash account, and an increase to an asset account is a debit. An increase to notes payable is an increase in a liability account, so that's a credit, and we put a memo on that transaction and we call it borrowed cash from bank. Third transaction. The company purchased office equipment for $4,500 in cash. Now, on March 3rd, when they purchased office equipment, what did they get? They got an increase in an asset account that we'll call office equipment. or just equipment. They paid cash for it. What did that do to their cash account? Yeah, it decreased their cash account, and their cash account is what kind of account? It's an asset account. So in this transaction, there was an increase to an asset account and a decrease to an asset account. So when we journalize this transaction, we would have said, hey, there was a debit to the asset account that we'll call equipment. So that got the debit of $4,500, but cash was decreased, and whenever I decrease an asset account, I have a credit of $4,500. Let's look at this a little bit neater. We've got the debit to equipment of $4,500 and the credit to cash of $4,500. I've got my date and I've got my memo. Next transaction. Number 4, the purchase of insurance. The company purchased 6 months of insurance for $1,200 in cash. What happened when they did that? Yeah. They purchased 6 months of insurance all on one day. We call that prepaying. Now, prepaying an account, and some of you may do this when you buy insurance for your car especially, what you get is an asset. You get 6 months of insurance already prepaid. That's considered an asset. So we've got an asset that increased, $1,200 of an asset that increased, called prepaid insurance. And how did I pay for it? Yeah, I paid for it with cash. I decreased my cash account, which is an asset account. Let's look at that journal entry then. I've got prepaid insurance. That's the name of that prepaid account. That increased. That is an asset account, and it did increase, so it was a debit of $1,200. I paid for it with cash, so that was a decrease in an asset account, which is a credit. I have a memo on that, and I've got a date. Next transaction. On March 6th, the company purchased office supplies for $6,500 on credit, meaning they did not pay cash on that day. They owe the payment within 30 days. What happened? Yes. They purchased office supplies. They now have in their supplies account, or their supplies inventory account, we sometimes call it, they have an increase. That's an asset account, right? Did they pay cash for it? No, they owe money. When you owe money, you should hear the word liability ringing in your head. They have now increased a liability, and that's accounts payable because they owe it within 30 days. So if I were going to journalize this, I have an increase in an asset account. That's got to be my debit, right? I've got a debit for $6,500, and that's my supplies account, my supplies inventory. And I'm paying for it by increasing a liability whenever I increase, whenever I increase a liability account, in this case it's accounts payable, I've got a credit. So let's look at that nice and neat. Increase in an asset, increase in a liability. My debits and credits are equal. I've got a date, but what am I missing here? Ooh, it looks like here we missed the memo. Purchased office supplies. There you go. All right. Now let's move on. On March 10th, the company sold advertising services. That's one of the things they do. They sold their advertising services in exchange for $8,800 in cash. Now they sold something. What part of the big accounting equation was affected? When a company does their normal day-to-day selling, is that affecting assets or liabilities or stockholders' equity? If you said stockholders' equity, then you're correct. Because what it actually affects is retained earnings. When a company does their selling, they increase a revenue, and revenues increases net income, which increases retained earnings. An increase in a revenue, in stockholders' equity is going to be a credit. So we know that the company had a credit to service revenue account of $8,800. And what did they receive? Yeah, they received cash. So there was an increase in an asset account, and an increase in an asset account would be a debit. So let's look at that journal entry. If I had an increase in an asset and an increase in retained earnings, then I had a debit to the asset account of $8,800 and a credit to service revenue because of the sale of advertising service for cash on the date March 10th. Let's go to the next transaction, transaction 7. The company sold advertising services, once again doing normal day-to-day selling, this time in exchange for $3,300 on credit to be paid in 30 days. So the company they sold to did not pay them cash immediately. They've agreed to pay within 30 days. Now, this one's already filled in for us, so let's check it out. The company sold advertising services, so it was an increase in a revenue, which is an increase in retained earnings. They also did not receive cash, but they did, by getting the promise of payment from the customer, they did get themselves an increase in a different asset account. And that would be the accounts receivable asset account. So there is still a $3,300 increase to assets, which is a debit of $3,300, this time to accounts receivable. And then there's a $3,300 credit, which is the service revenue. We have a memo and we have the date. Now, on March 19th, transaction number 8, our friends at High Tech received $9,000 in cash for advertising services that will be completed in the next 3 months. Have they completed it yet? No, they have not. Can they successfully say they earned the revenue then, if the services have not been completed yet? No, they cannot. So what we have here is we have an increase in an asset account, which is the cash account, because they got $9,000 in cash. But they haven't done the work yet. They have an unearned service revenue liability now. They are hopefully going to recognize that revenue in the next 3 months, but they have not yet earned it. So let's look at how we actually deal with that. We put the date and we say, hey, awesome, we've got, $9,000 in advertising services, $9,000 in cash that has been received, but we still owe all the work, so we have unearned revenue liability, and that's a credit entry of $9,000. And here we have the memo sold the advertising services in advance. Every time you have unearned revenue, you have a liability, and an increase in a liability is always going to be a credit entry. Transaction 9. On March 23rd, the company, High Tech, paid $6,000 in cash for the previously purchased supplies. Remember, in transaction number 5, they had purchased supplies on credit. Now they're actually going to pay back some of that. Not all of it, but some of it. So if they had originally purchased it on credit, they originally had an accounts payable balance. So now they're actually going to pay off some of that accounts payable, which means they're going to decrease that liability. Plus, if they're going to pay cash for it, they're going to have to decrease their cash, right? Let's look at how we journalize that. We had a decrease in cash, which is a decrease in assets, a decrease in accounts payable, because they are paying back what they owe, so it's a decrease in a liability. A decrease in a liability is going to be a debit. Because remember, any increases to liabilities are credits, any decreases to liabilities are going to be debits. There's a debit to account payable on March 23rd. There is going to be a credit to cash because cash decreased, and that is because we paid off some of our accounts payable. Transaction number 10. The company is going to pay $1,800 in weekly employee salaries. What's going to be happening here? Well, we're going to assume they're paying cash, which means there's going to be a decrease in the asset account for cash. When they pay weekly employee salaries, what actually is going to be happening is going to be a decrease to retained earnings because we're going to be having an expense. An expense decreases net income, which decreases retained earnings. Any decrease in retained earnings is going to be a debit, and the decrease in assets is going to be a credit. So let's look at how this happens. There's a decrease to assets of $1,800, a decrease to retained earnings of $1,800 because of that salaries expense. So on March 26th, there's a salary expense debit entry of $1,800, which matches this decrease up here. And there is a credit entry to cash, all because we paid employee salaries. Transaction number 11 says that we collected $3,000 in cash for services that were sold earlier on credit. Remember transaction number 7, they sold advertising services, but the company they sold to didn't pay them immediately? So initially they had an asset account, they had that accounts receivable of $3,000, but now that's going to get paid back. So there's going to be a decrease to accounts receivable, but they're receiving cash for it right now, so there's going to be an increase to cash. So it's all going to be happening in the asset accounts. And so let's look at how that happens. On March 29th, they receive cash, which is a debit of $3,000, and they're going to clear that accounts receivable, which would now mean we have a decrease in an asset account, which is a credit of $3,000, and we say that they collected accounts receivable. Transaction number 12, we're going to lay it right out for you. They paid a utility bill on March 30th for $5,200. Now we're going to assume that this was utilities that they actually used in March. They're not paying ahead, they're just paying for whatever happened in March. It's going to be an expense. An expense is a decrease to net income, which is a decrease to retained earnings. So that's why we have this negative $5,200 affecting retained earnings over here. And we're going to assume that they paid in cash. If they did, that's a decrease to the cash account, which is an asset account. On March 30th, when they journalize this, they've got a utility expense, which is a debit of $5,200. Remember, any expense is going to decrease net income, which decreases retained earnings, and retained earnings has a normal credit balance. So if I'm going to decrease something that has a normal credit balance, I must have to have a debit entry. And then I'm going to decrease cash, which is a credit entry of $5,200, and that's because we paid the utility bill. The final transaction, transaction number 13, is on March 31st, High Tech declared and paid a cash dividend of $500 to stockholders. Now, it was paid in cash, so we can assume there was a decrease to assets. Now, what happens when a dividend occurs? Well, we know that dividends decrease retained earnings, which decreases stockholders' equity. And since stockholders' equity has a normal credit balance, any decrease must be a debit, right? So on March 31st, there is a debit of $500 to the dividends account because we decreased stockholders' equity by issuing the dividend. We also decreased cash, which is an asset account, so that's a credit. And we put a memorandum that says paid dividends with cash. This concludes the high-tech transactions analysis.